All right, let's dive into a topic that is fundamentally reshaping the entire banking world, the final Basel III reforms. If you're in a leadership position at a bank, understanding this isn't just about compliance anymore, it's about core strategy. So, let's get right into it.
And that's really the big question, isn't it? As you're about to see, being ready for this is so much more than a simple compliance check. It's about really grappling with the deep strategic implications for your business, your data, and how you allocate capital for years to come.
And let's be really clear about this. This isn't just another regulatory update that you can hand off to the compliance team. It fundamentally re-engineers how you measure risk and plan your capital. This elevates the conversation from a simple requirement to a core boardroom discussion.
So here's our game plan. We'll start with the why behind all these changes. Then we'll dig into the three massive shifts that are going to impact your operations: standardized risk, internal models, and the new leverage ratio for GSIBs. And we'll wrap up with the key strategic moves your institution needs to be thinking about right now.
First things first, let's set the stage. The main reason for these reforms was to solve a massive problem that the financial crisis laid bare. Nobody really trusted how banks were calculating their own risk anymore.
The two key words from the Basel Committee here are credibility and comparability. You see, under the old rules, you could have two banks with almost identical portfolios reporting wildly different risk-weighted assets, or RWAs. These reforms are all about stamping out that inconsistency to create a much more level and transparent playing field.
And that leads us straight to the first major overhaul, a complete revamp of the standardized approaches that most banks around the world rely on.
The biggest change by far is in credit risk. The old way of using simple, flat risk weights, that's gone. It's being replaced by a much more granular, risk-sensitive system. What this really means is that the specific details of every single loan and the quality of the data you have on it now directly and powerfully impact your capital requirements. This slide is a perfect example. Just look at residential mortgages. Before, they might have all been lumped under one risk weight, but now, the risk weight is tied directly to the loan-to-value ratio. A loan with a low LTV gets a 20% risk weight, but one with a high LTV can jump all the way up to 70%. This kind of shift demands a much deeper, much more sophisticated approach to data management. Now, the change in operational risk is even more dramatic. The option for banks to use their own advanced internal models, the AMA, has been completely scrapped. The committee basically decided that trying to model for things like fraud and misconduct was just too complex and way too inconsistent from bank to bank. So, what's taking its place? A single, new standardized approach for every bank. It all boils down to a pretty simple formula. Your operational risk capital is based on two things: your business indicator component, which is basically a proxy for your bank's size and complexity, and your internal loss multiplier, which reflects your bank's own historical loss data. So how does that business indicator component get calculated? Well, it's based on your bank's income-generating activities. But here's the key takeaway. The formula is designed to scale up. The bigger and more complex your bank is, the higher your capital requirements for operational risk will be. It assumes that your risk grows at an accelerating rate. Okay, so we've talked about the standardized approach, but what about those banks that do use their own internal models for credit risk? Well, the new framework introduces some very significant new constraints. Think of them as regulatory guardrails. First off, the most advanced internal models, the AIRB approach, are now off-limits for certain types of assets, where modeling has just proven to be too unreliable. We're talking about things like exposures to large corporations and other banks. For these, you have to go back to using a more constrained model or just use the standardized approach. And this number you see right here, this is arguably the single most impactful change for any bank that relies heavily on its internal models. This represents a brand new, hard limit on your capital calculations. This is the new output floor, and what it means is this. No matter how sophisticated or brilliant your internal models are, your final RWA number can never be lower than 72.5% of the number you'd get using the new standardized models. This fundamentally caps the capital benefit and the strategic advantage of using internal models in the first place. Now, this isn't happening overnight. The floor is being phased in gradually, starting at 50% and climbing all the way to that final 72.5% in 2027. And this timeline is absolutely critical for your long-term capital planning and strategy. The fourth major area of reform is aimed squarely at the world's biggest institutions, the global systemically important banks, or GSIBs.
they are now facing an additional capital buffer.
And it's really important to understand that this new buffer is a completely different animal from the one they already had. The original GSIB buffer is based on those model-dependent, risk-weighted assets. This new buffer is a simple, non-risk-based leverage ratio. Think of it as a blunt instrument, a hard backstop designed to put a ceiling on total leverage and act as a safeguard against any potential flaws in the RWA models.
The calculation itself is pretty straightforward. The new leverage ratio buffer is simply set at a half of whatever the GSIB's existing risk-weighted buffer requirement is. So for example, if a GSIB has a 2% risk-weighted buffer, it now also has to maintain a 1% leverage ratio buffer. Simple as that.
So after all that, what does this actually mean for your institution? What are the key strategic adjustments you need to be making? Let's boil it all down into 5 critical action points.
These changes really demand a fundamental rethink. First, you have to reevaluate your models. With that new 72.5% output floor, you've got to ask if the cost of maintaining these advanced internal models still justifies the now limited capital benefit. That flows directly into your capital planning. Second, your data infrastructure has to become a top priority. These new granular standardized models require data at a level many banks just aren't set up for. And finally, you have to reassess the profitability of your business lines through this new lens, factoring in everything from the new operational risk formula to, if you're a GSIB, the impact of that new leverage buffer. Which brings us to the final critical question for your leadership team to wrestle with. With all these new guardrails and floors, you have to ask, are your internal models still a key strategic asset that gives you a competitive edge? Or are they slowly becoming an expensive compliance liability in this new, more standardized world? That's the strategic challenge to consider. Thanks for joining me.